You think the system is looking out for your retirement and your savings are completely secure under new political leadership, but the absolute reality is that the central bank is completely trapped and you are actively being set up to be the ultimate exit liquidity for the next massive wave of inflation. Before we expose the absolute fiction coming out of the Federal Reserve right now, do me a massive favor and drop a comment down below with your current age and the exact amount of money you manage to aggressively save and invest every single month. Seriously. Type those numbers out right now because the data does not lie and we need to see who is actually executing a real plan for financial freedom versus who is just complaining on the internet while inflation melts their purchasing power to absolute zero. The era of Jerome Powell is officially over, and President Donald Trump has brought in Kevin Warsh to run the Federal Reserve. We all saw the public drama where Trump openly ridiculed Powell on numerous occasions, calling him an idiot and a dummy in front of global reporters because Powell refused to cut interest rates as quickly as the administration wanted, leading up to the elections. But you have to understand that this was not just a personal beef, it was a fundamental clash between political desires and harsh economic reality. Trump wanted low interest rates to give an artificial boost to the labor markets and the economy, but Powell knew that cutting rates prematurely would unleash an unstoppable firestorm of inflation. Now, Kevin Warsh is stepping into the driver's seat, a man with deep connections who is already worth an estimated $200 million and will likely see his network swell past $1 billion. After this incredible opportunity to manage the global monetary system, Wall Street wants you to believe that a change in leadership means a magical fix is coming. But the truth is that Warsh has been brought in to do two highly dangerous things: print trillions of dollars and force interest rates down. The ultimate question you need to ask yourself is how can any Fed chair realistically cut interest rates right now, in 2026, when the rate of government reported inflation is actively soaring? Look at the actual data. For years, the Federal Reserve has drawn a strict red line trying to bring the rate of inflation down to a target of 2.0%. Powell looked ridiculous, calling this high inflation transitory for over 6 years. But the recent chart tells the real story. In February, the inflation rate was sitting at 2.4%. In March, it jumped noticeably to 3.3%, and by April, it gapped up to 3.8%. Remember that these are heavily manipulated government figures, meaning the real-world cost of your groceries, your rent, and your insurance is wildly higher than what they admit on television. We are stuck in a global environment where persistent energy disruptions and geopolitical conflicts are driving oil and gas prices through the roof. And this energy shock is not ending anytime soon. In a world where basic structural inflation is accelerating, demanding an interest rate cut is absolute economic insanity. Put yourself directly in the shoes of Kevin Warsh right now to understand the massive trap. On one hand, the powerful president who handed you this massive job is publicly demanding that you slash interest rates to juice the stock market. If you refuse to cut rates, you face immediate political retaliation, public tantrums, potential criminal probes, and the loss of your ultimate billionaire status. On the other hand, if you actually listen to the political pressure and cut interest rates when inflation is already at 3.8%, you will completely destroy the purchasing power of the American dollar, trigger a massive hyperinflationary feedback loop, and completely screw over regular everyday families. It is a brutal choice between personal greed and structural collapse. But let us look at what the public markets actually expect to happen. According to the CME Fed Watch tool, the upcoming Federal Reserve meeting on the 17th of June is showing a 98.9% probability that interest rates will remain completely unchanged. The market is pricing in a tiny 1.1% chance that the Fed will actually raise interest rates by 0.25%, and there is an absolute 0% chance of a rate cut. Even though the political administration is screaming for immediate relief, the market does not buy the hype for the June meeting. If you look further down the line to the 29th of July meeting, the market sees a 92.6% probability that rates stay flat, with a rising 7.4% chance of a rate hike and a 0% chance of a rate cut. In fact, if you track the expectations all the way to the December 2026 meeting, the institutional smart money is predicting that there will not be a single solitary interest rate cut for the entire year of 2026. Trump might hold his tongue for one meeting, but if Warsh goes the entire year without delivering a rate cut, you can fully expect historic public tantrums that will send shockwaves through the financial media to make matters even more hilarious. Warsh is currently telling the public that he plans to do the exact opposite of money printing. He is claiming that the Federal Reserve will aggressively shrink its multi-trillion-dollar balance sheet by letting assets run off and dumping us treasuries back into the open market. To that absolute fantasy, I say yeah, right? Believing that the Fed will successfully shrink its balance sheet is like believing that corrupt politicians are going to volunteer to go to state prison for insider trading. It is pure fiction. The reality is that the interest rates on government debt are skyrocketing to highly uncomfortable levels. The 30-year Treasury yield is slammed at 5.13%, and the 10-year yield is climbing past 4.6%, indicating that the foundational bond market is in massive structural trouble. Good luck trying to shrink a balance sheet when the government is already drowning in debt and needs to constantly issue more bonds just to pay the interest on its existing obligations. If Warsh actually attempts to force the balance sheet down, he will cause catastrophic economic damage. Dumping treasuries will push bond yields even higher, which immediately translates into massive interest rate spikes for everyday consumer mortgages, high-interest student loans, credit cards, auto loans, and corporate business loans. The federal government would be forced to allocate a massive portion of its budget strictly to interest expenses, causing the deficit to explode even faster. The central bank is already printing billions of dollars behind the scenes just to keep the cracks from shattering the entire banking system, and it is still not enough. This leaves the average regular citizen completely exposed to a slowing economy on one side and a soaring cost of living on the other. Many people are terrified that the Fed might actually raise interest rates to 4.0% or 4.25% to combat this inflation. But you need to wake up and realize that a tiny quarter-point increase is completely useless. The last time the Federal Reserve actually successfully crushed a massive inflation crisis, the chair had to raise interest rates all the way to a staggering 20%, trying to suppress a raging fire with a tiny squirt gun. Like a move from 3.75% to 4.0% is a complete joke. Mathematically speaking, raising rates to 10% or 15% today is completely impossible because it would instantly bankrupt the U.S. Treasury and cause a complete meltdown of every single commercial bank in the country. The Federal Reserve is fundamentally trapped. All roads lead directly back to massive historic money printing. And the value of your cash is the ultimate casualty. This is exactly why regular people get absolutely slaughtered in public markets. They sit around waiting for the government or the Fed to save them, holding on to depreciating paper money, while institutional players protect their own generational wealth. If you want to achieve true financial freedom and protect your family from this inevitable monetary debasement, you have to completely reject the mainstream financial narrative. Stop wasting your time trying to time the market or guessing what a group of billionaires in Washington will decide at their next meeting, because time in the market will always beat timing the market. You do not need a fancy actively managed hedge fund, you do not need complex alternative products, and you definitely do not need to take investment advice from mainstream media anchors who are just paid to generate panic and clicks. True wealth accumulation requires absolute personal discipline, aggressive saving habits, and a dedication to automated dollar cost averaging into real productive assets. If you want to secure your financial future, you need to ruthlessly optimize your personal cash flow. Look at your bank account right now and cut out every single dollar of useless consumer spending. Drive a beat-up 2006 sedan that is completely paid off. Live in a simple minimalist apartment, ignore the urge to buy designer clothes, and stop trying to impress people you do not even respect with credit card debt. View every single dollar you save as a dedicated soldier that you are deploying to build your personal wealth empire. Once you have established a clean 6-month emergency fund and a high-yield savings account to protect against job loss or economic friction, you put your investing strategy on absolute autopilot. You must execute a strict monthly or weekly dollar cost averaging plan into low cost. Transparent index funds like VOU, which instantly gives you ownership in the 500 largest and most profitable corporations in the United States. When you invest in VOU, you are buying into companies with massive global revenue, actual products, real profit margins, and dominant market shares. Businesses like Apple, Microsoft, Amazon, and NVIDIA do not get to hide behind private spreadsheets or accounting tricks. Their values are continuously tested by millions of global participants every single second. When the market inevitably panics and drops because of Fed headlines, your automated contribution simply buys more shares of these incredible companies at a major discount. When the market recovers, your net worth surges. You do not need to guess the bottom. You just need the discipline to keep buying month after month, completely ignoring the short-term noise. If you want a strategy that prioritizes consistent cash distributions and resilient dividend growth, you can pair your portfolio with an exchange-traded fund like SHD. This fund filters for high-quality U.S. companies that have a proven historical track record of paying and consistently growing their cash dividends over time. Unlike the fake yields or accounting illusions promised by risky alternative investments, the dividends from SHD are backed by actual underlying cash profits from mature, sustainable corporations. This cash is deposited directly into your account, giving you real-world liquidity that you can choose to automatically reinvest for compounding growth or use to cover your daily living costs. To truly maximize this wealth-building machine, you must utilize tax-advantaged vehicles like a Roth IRA. In a Roth IRA, you are investing your money after taxes, meaning every single dollar of capital gains, price appreciation, and dividend growth compounds completely tax-free forever. When your disciplined dollar cost averaging turns your account into a multi-million-dollar nest egg over the next 20 or 30 years, you can withdraw that wealth in retirement without paying a single penny to the government. It is the single greatest legal tax shelter available to the working class. Yet the vast majority of people fail to max it out every year because they are chasing get-rich-quick schemes or overspending on temporary luxury items. Wall Street wants you to think that building wealth is an incredibly complex game that requires their expensive management services. But history proves that over 90% of active fund managers fail to beat a simple low-cost index fund over a long-term horizon. They collect their guaranteed fees whether they grow your capital or destroy it, leaving you with all the risk by taking absolute control of your personal finance, living far below your means, and consistently automating your investments into VOO and SCHD within a Roth IRA. You effectively opt out of the institutional exploitation machine. The ongoing drama at the Federal Reserve is just another predictable chapter in the long history of credit cycles. Money printing is an absolute mathematical inevitability, and the resulting inflation will continue to punish anyone who chooses to sit on cash or chase speculative hype. The disciplined, patient retail investor who understands macro fundamentals does not panic during these cycles. Instead, they see market volatility as the ultimate opportunity to acquire dominant assets at a discount. Keep your expenses low, keep your discipline high, automate your contributions, and let time in the market do the heavy lifting for your net worth. Hit that subscribe button. Peace.